Welcome to our video series on inbound Australia tax updates. This video is focused on the Intangibles integrity measure. My name is Jonathan Malone. I'm a global tax partner at PwC, and today I'm joined by Danieletto and Jayde Thompson, fellow tax partners in global tax. And so thanks very much for being able to join today. And maybe to kick it off, a question to Ange, which is basically, are you able to, broadly speaking, give an overview about how these rules are expected to operate?
Sure. So at a very high level, these rules can operate to deny deductions for payments relating to intangibles where there is income derived directly or indirectly in a low tax jurisdiction. And that low tax jurisdiction concept is primarily defined by reference to a 15% tax rate. So for some context, this measure was first announced as part of Labor's first federal budget handed down last October. Since then, we haven't seen much information as to the detail of this new measure until the exposure draft was released on 31 March for public consultation. And so the short of it is this measure is extraordinarily broad. And one thing that's really struck me, and I know others as well, is that this measure is described in many places as an anti-avoidance measure. That said, there is no purpose test and there's also no substance-based carve-out. Additionally, the provisions are self-executing, which means there's no discretion as to whether or not they apply. So I think practically what that means is that you could be denied deductions, notwithstanding the fact that your business model and your arrangements weren't established with any purpose or design of shifting income to low tax jurisdictions. So when you look at it that way, I am struggling to kind of describe this as an anti-avoidance measure.
And Ange, a key part of how these rules operate is that test based on whether something is taxed at a 15% rate in the foreign jurisdiction or less than, in which case it would be caught. So some observations about testing that rate?
Yeah, so it sounds simple, a 15% tax rate, but actually the way the provisions work, it's a bit more complex than that. There's a number of aspects to the test, and so it's not as simple as necessarily working out if the relevant jurisdiction has a headline corporate tax rate of above 15%. I think the other point to note on that test is the legislation allows the minister to make regulations to essentially designate other countries to also be low tax jurisdictions if they have a preferential patent box regime. So I think that's something to look out for as well.
Great, thanks. And given your description of this being particularly broad, then some of the questions that are coming up relate to the uncertainties that are inherent in the drafting. And maybe you could expand on some of those uncertainties that you're observing.
So I think on uncertainties, I think Jayde and I will have a long list on this one. But one area of uncertainty is going to be around identifying what arrangements you have that need to be tested. And the relevance of this is because the rules essentially test payments made in the context of an arrangement. And that term arrangement is already very broadly defined in the Australian tax law. It goes beyond legal contracts and agreements, and it can include non-enforceable undertakings. And the explanatory materials make very clear that the use of the term arrangement was very deliberate, and that the intention is that taxpayers will have to look outside their legal agreements essentially to identify what arrangements need to be tested. And I think linked to that uncertainty is also there is a specific requirement that which means that you'll need to trace payments through interposed entities, and there is no nexus element built into that requirement. So I think that means potentially you're going to be tracking payments all the way through your value chain. And interestingly, on that tracing requirement, the wording that's used in the provision is the same wording that was used in the similar requirement in the imported hybrid mismatch rule. And for those of you who had to undertake tracing exercises in that context, no doubt you'll recall how tricky it was and how uncertain some of the outcomes were on that point. So Jayde, I think you'll probably have some additional items to add to the uncertain list.
So for me, there's a couple of uncertainties that really stand out. The first one is around apportionment. The draft law uses words to the extent, which clearly contemplates a situation where you have an undissected bundle of rights that clearly need to be apportioned out and separated and allocated to different parts of the payment. There is also some uncertainty around language used in the explanatory materials where you have genuine payments and the need to look at proportionately the amount of the deduction that could be denied where you do have a genuine payment scenario. And on the apportionment piece, it's clearly expected that an exercise will need to be done, but the rules don't provide any guidance on how you actually undertake that apportionment exercise. And so we all know that there are multiple different transfer pricing methodologies that could be applied to apportion, and so careful consideration will be required to actually undertake that exercise. Another uncertainty for me is around the mischaracterisation of payments. I think the draft law provides additional scope to allow for the mischaracterisation of payments. So if you think about things like reseller fees or service payments, they will need to be considered in context of this new law, given that ability to capture mischaracterised payments. And the last point is around in-scope payments. There is some uncertainty around the definition of intangible asset and how, exclusive rights to distribute tangible products might get caught up in the draft rules. So that's another area that if you've got tangible products that you're distributing in Australia, that will need to be carefully considered as part of these new measures.
Thanks, Jade. And how do you see these measures interacting with other rules and concepts internationally?
So the key for me here, which came through pretty clearly in the draft law, is the fact that there's no contemplation of how the rules will interact with things like controlled foreign company rules in various jurisdictions, the Pillar 2 income inclusion rule, or even qualified domestic minimum top-up tax regimes that are implemented by countries. There's clearly some uncertainty around those countries who might be implementing those regimes and how that factors into the calculation of the 15% tax rate. And I think if you're a jurisdiction such as Ireland, who has a 12.5% tax rate, or even Switzerland with an 8.5% national tax rate, there are some questions around that interaction.
Thanks. And so the thing that's really apparent to me with a 1 July 2023 start date is that there might be some small changes around the edges to do with how this will be introduced into Parliament. But the reality is we're expecting the vast majority of the structure of these rules to remain the same. And so therefore, if you've got questions about how this applies and how to interpret these provisions, then please reach out to your PwC partner contact in the list below, and we'll work through and try and clearly provide guidance going forward in the months ahead to what is a very broadly drafted measure. So thank you.